in order to get your money out, after you get the property stabilized and rented, you have to get a cash out refinance to get your money out, correct?
Correct. Yep.
Yeah. So when you do a cash out refinance, that type of refinance usually has a higher interest rate, and then you pay more discount points to the lender in order to get cash out refinance.
Hey guys, welcome to our weekly mastermind call. Excited to have Oggie Penev on this call. He's going to talk about his BRRRR strategy that he's been using in his business. Excited to learn about that. I would say it's one of the more popular investing strategy a lot of investors starting out utilize. So I'm excited to hear what you have to share. So Oggie, if you want to give a little bit intro about yourself, and then if you have a presentation that you want to do, or just make it Q&A, whatever is comfortable to you, we can do that.
I'll do a little presentation,
Sure.
so you can follow my thought, and everybody can get an idea what I have, like an interesting strategy that I've been using for the last 5-6 years to buy rental properties. But a little bit about me. So I'm a real estate broker. I started as a real estate agent in 2005. Later in 2010, I opened my own brokerage, started working with a lot of foreclosure properties at the time, bank-owned short sales. And in 2016, I bought my first rental. And that's how I started my portfolio at that time. And later, when I intentionally decided to open a property management company, because I started acquiring a bunch of rentals. So I said, hey, why not just handle it myself? So since 2019-20, I started. I have a company called ProX Realty Management that we manage properties here in the Phoenix market, Maricopa County. I'm physically in Phoenix. So later at that time, I started an investment company, Home Pro Invest. We buy properties in the state of Arizona. We do pay-per-click, direct marketing to homeowners, and we bid on trustee sales. So we do acquisitions of properties too. And over the time, I've managed, bought, sold a lot of properties, probably close to $1 billion of real estate. So over this time, kind of acquired a pretty unique experience in the buy and hold business, looking from 360 degrees view of the investment cycle. Like I can look at the process from an investor, as a property manager, as a real estate broker, as an owner. This kind of provide me with the knowledge I have right now with create different strategies. And I recently last year started a consulting company specifically for buy and hold investors. And that company specifically helps not just the real estate side of the business, but more like creating strategies about overall the business of the buy and hold business, as a real estate, taxes, the financing, and the legal side, everything that works together. So.
Cool. Yeah, that sounds great, man. I can't wait to see your presentation. So you should have access to share screen.
Yeah, I know you have rentals too, right?
Yeah, I do. I have about 50 rental properties. Yeah.
And you do most of the BRRRR, right? Or just buying in?
Yeah, I have my rental properties in Indiana. I've done some BRRRR. I mean, I didn't live in any of the properties, but they, bought, refinanced a couple of them. I have loans on just 2 of my properties. Everything else is paid for. But for those, I didn't even know it was called BRRRR back then. But I bought them, rehab them, and then rented them out, and then went to the bank to take some money out to buy more rental properties.
Gotcha. Okay. And now you have it more paid off?
I have, except 2, all of them are paid off. So I have the 2 loans are just like $100,000 in total, but everything else is paid off. Gotcha. I used to be a huge Dave Ramsey fan when I started investing. So I just went with that mindset. Just pay off
I used
everything.
to be EOP with Dave Ramsey too, but I went on the dark side because I'm the opposite of you. I don't like paid off properties. I leverage as much as I can.
Yeah, no, I just like the mindset back then. I started investing in 2010. I just felt more comfortable, with everything going on with the real estate market back then. I just felt more comfortable with that. Yeah, so it's worked out all right. Yeah.
Yeah. Cool. So I will do a little presentation specifically about the BRRRR strategy, and then feel free to stop me or ask me question during the presentation, and or at the end we can do Q&As also specifically for that.
Sounds good.
That strategy. So all right. So so the consulting company that I just mentioned that started it's I call it the Buy and Hold Academy, and practically I use all my experience for the last 10 years and everything about real estate, taxes, financing, and legal side of the buy and hold business specifically. So I'll be going over that in a bit. So let's talk about the basic BRRRR. I mean, most people are pretty familiar. So you buy the property, try to find a property in distressed situation below market value, then rehab the property, add some additional value, and rent it, start getting income, then go to the bank, refinance the property, and get the money out so you can repeat the process. I'm probably that's what you've been doing so far, correct? And everybody.
That's what I basically did, except I just did buy, rehab, rent, and never and repeat. I skipped the refinance part.
Yeah, so that's what I started to do the same thing in 2016, but I realized that with the cash that I had at that time, I'm not going to be able to go too fast. I'm going to have to buy the property, lock some of my cash in the actual deal in the house, and then after 2 or 3 houses, I will be out of cash. So I needed to come up with a little bit better strategy. So that's why I kind of stumbled and I perfected a strategy that I called later BRRRR on steroids, because it's the actual BRRRR, but you speed it up the process and buy way more properties than the usual way. So I called it, BRRRR on steroids, pretty catchy name just to get an idea. So let's start with the main problem with the BRRRR. The first thing is, in order to get your money out after you get the property stabilized and rented, you have to get a cash out refinance to get your money out, correct?
Correct. Yep.
Yeah. So when you do a cash out refinance, that type of refinance usually has a higher interest rate, and then you pay more discount points to the lender in order to get cash out refinance.
Yeah, plus you have seasoning requirement also in most banks.
So another requirement.
There you go. Yep.
So seasoning used to be 6 months, now it's a 1 year. So in order to use the full appraisal value of the property, you need to own the property for 1 year at the moment. It used to be 6 months, but in April this year, Fannie and Freddie changed that rule. Now it's 1 year. So within this year, the refinance value for the property is based on the purchase price that you bought the property, not on the actual appraisal value. So within the first year, that's a huge problem. Even if you buy a property for $200,000, you improve it, the property value, appraisal value comes at $300,000, and you go to refinance, the bank is not going to use the appraisal value. In the first year, they're going to use the $200,000, the purchase price that you bought the property. So within the first year with Fannie and Freddie, you cannot use the appraisal value. You're going to have to use the purchase price, and that's a little problem. And with this, you're leaving money locked in the property, because the money that you have to do for down payment to buy the property and the repair costs that you have during, for the rehab, that's going to be locked in the property for a year until you're able to get to the appraisal value. So this is the main problem with the cash out refinance that is needed for the BRRRR, the regular BRRRR strategy. So let me give you a kind of an example that what I had. So let's say you find a property that needs repairs and you have the cash to purchase the property. So let's say you purchase the property for 200,000, you need a rehab of 40,000, and your total cash in is going to be 240. Appraisal value after you're done with the property is going to be on 300,000. That's your initial calculations. So for now, your total cash in out of your pocket, 240,000. So once you're done and probably rehab for a month and then rent it, and 2 months later, you want to go to the bank to refinance, the bank can give you up to 80% of the purchase price because we don't have the seasoning of 12 months. So even though the appraisal comes at 300,000, they will take the purchase price of 200,000 as the value that they can base the refinance on. So from 200,000, they can give you only 80%, and that's
so. Do you still have to get an appraisal done within the 12 months?
Yes, every time you do a refinance, the bank is going to ask you to do an appraisal regardless. But when they see that you purchased the property less than a year, they're going to ignore the appraisal and they're going to go to the purchase price. And if you go that route,
unless in a very, very unlikely situation, the appraisal comes in below the purchase, then they'll take the appraisal. Right?
Then you're in big trouble. They should be. Then you should not be an investor. Maybe you should need some training somewhere. So, but if you do it this way, you did a great deal. You bought a great property, but you locked $80,000 cash into this deal, and for a year you cannot touch this money. So the money stays in the deal. So let's say you find a property that it's already with a tenant. You just buy it. You don't have to repair it. Let's do the same scenario. 200,000, no rehab, total cash in 200,000. Appraisal is 300,000. Really good deal. You can't miss it. You put cash 200,000, and then you go to refinance, and you say to the bank, "Hey, this property is worth 300,000. I'd like to get my money out." The bank says, "Yeah, but you don't have 1 year seasoning. We don't care about the appraisal value. We have to consider the purchase price as the value." So they say within the first year, we can only refinance 160,000 out of the 200,000 you pay for the property. So in this case, you're still leaving 40,000 in the property, locked in the deal. So let's say you don't have the cash and you work with private money lenders. Let's run that scenario to see how that looks like. So property needs repairs with private money loan. Purchase 200,000. You have the down payment that the hard money lender requires 40,000. Then you take a loan for 160. The rehab is 40,000. You're gonna get the appraisal after repair value and appraisal at 300K. Your total cash in for down payment and rehab is $80,000. So then you same thing. You go to refinance, and the bank says, "Sorry, we're gonna have to use the purchase price. We cannot use the appraisal value within the first year. We can only refinance the 160,000, which is 80% of the purchase price, pay back the hard money loan." In this case, you still have the money for down payment and the rehab that you spend locked in this house for a year, and you cannot touch it. You cannot refinance. You cannot do anything with that. So let's same thing, private money loan, no repairs, purchase 200,000, down payment. This time you don't have a rehab, but you still have 40,000 for the down payment. You try to refinance it, the bank says comes the same thing. We can only refinance 80% of the purchase price in the first year. And so you have 40,000 left in the property. So we as a buy and hold investors, we always want our money to move and buy more properties and acquire as many as we can. When you have a limited amount of cash, once you start living 80,000, 40,000, 80,000 in properties, pretty quickly you could run out of cash. So getting the cash out became the biggest problem with the regular BRRRR strategy. So we had to figure out a way around this so we can get our money faster so we can put him into another property as quick as possible. So the main problem became the term and the restrictions of the actual cash out refinancing. Not the whole process, but the only piece was that you are trying to get the money out doing cash out refinance, because that cash out refinance had a lot of restrictions. And the main restriction in the fact that it's being more expensive was the seasoning for 1 year. So I had to find a way to go around that seasoning for 1 year and not use cash out refinance. So the solution that at that time that I figure out exists is to change the refinancing. Instead of doing a cash out refinance, we switched doing to another type of refinance called rate and term refinancing. So we had to do the BRRRR, getting rid of the cash out refinance, and switch to rate and term refinance. Are you familiar with these two terms, like cash out and rate and term? Have you used that?
Cash out I have, but rate and term refinance, I'm not familiar with it.
So
yeah,
the good thing for, so rate and term, practically what it does mean, replacing an existing loan with another loan that just has different terms and rates. So rate and term refinance, replacing already existing loan with another loan. With the rate and term refinance, there's no seasoning. Next day, after you're getting a loan, you can go ahead and apply and do a refinance, and the bank has no seasoning. They can take the appraisal value the next day. And also, rate and term has lower fees and better interest rate because it's not considered high risk loan as the cash out refinance. So the main point here out of these three is that there's no seasoning. So this was my biggest problem when I was doing the regular BRRRR, that it took time for me to get my initial cash out, so I could not deploy the money again and buy more properties. So now that I found this, I found a way to get my money out as quick as possible and buy another property. So of course, less closing costs with the points. So there was some problems, of course, with rate and terms that I had to go around and figure out solutions. So with rate and term refinance, you're not allowed to get any cash out of the refinancing process. The maximum that the banks can allow you to get back is up to like 2%, and you can use that towards your closing costs. And also, the rate and term refinance, which was one of the biggest issues that I had to solve, is that applies only for purchase money loans, which means that you can only refinance money or loans that you took at the time you bought the property. Nothing after that. No equity lines of credit, no construction loans, nothing after that. Everything that you could refinance, it's only, for rate and term, it's only the purchase money loan at the time buying the property. So what I had to do is to prepare for rate and term prior to buying the property. First is that I had to create a purchase money loan from the very beginning, so I can later do rate and term refinance. So I had to avoid using my personal cash for down payment and repairs. Anything that I needed as a down payment and repairs, I had to include in the initial loan amount, the down payment and the repairs. So this way, I can wrap up everything from the very beginning with one big loan, purchase money loan, that I could refinance later immediately at appraisal value. Any questions so far? Does it make sense?
JD has a question. Does this work for flips done with hard money?
Yes, I'll show you right now how this applies exactly in a few different scenarios. So let's say the first scenario, creating a 100% purchase money loan using 100% private loan. I mean, 100% of your personal cash. Sorry, private loan. So let's say you buy the property for 200,000. Rehab is 40,000, and you get private loan for 240,000, which includes together the money for the loan and the money for the rehab. You borrow everything in advance. So you total cash in from your own personal pocket is zero. You pay nothing. So then later, when you fix the property and put a tenant, maybe a month later, 45 days probably, depends, 2 months, you go to the bank and say, hey, I have a loan, hard money loan, that I'd like to refinance. My property, it will appraise for 300,000, and I'd like to refinance, as maximum is 80%. And the bank says, okay, no problem. They come, they do an appraisal. The appraisal comes at 300,000, and they say, okay, no problem. Usually you have to give us 20% down payment, but you already have 20% equity. So you don't have to give us any down payment. They refinance the private money loan that you took for 240,000, and you're left with 30-year low interest rate, fixed rate loan that the rent covers that payment, and you have zero money left in the deal.
So you're getting the money upfront for buying and rehab, and that's the loan that you have with private money lender in that case.
Yeah, private, but let's say you have rich uncle and they trust you and they want to help you with your real estate business and say, hey, uncle, this is a great deal. Show them the numbers. Can you kind of borrow 240,000, 200 to buy it and 40,000 to repair it. And from the purchase time, you record a loan for 240,000, and that becomes a purchase money loan.
So it doesn't matter whether the money was used actually for purchase or not, whatever the initial loan was, whether it was used, part of that was used for purchase back or rehab, that all goes part of the purchase money loan.
Yes, the bank doesn't care what you bought the property for. They care about the purchase money loan.
Interesting. Yeah. There are a couple of questions. One from Warden. Is the scenario the same with hard money? If so, who covers the origination fees on the hard money in order for us to have zero out of pocket?
I'll run the scenario in a few slides, but it's a good question. You're ahead of me, guys. Good, you're paying attention. I like that. What's the second question?
The second question related to hard money. Also,
okay. All right. So let's run
the origination fee. Yeah.
So this is if you have someone that you can borrow 100%, no question asked. Family and friends, usually that's what happens. So let's say.
And sorry, one question I have is, is it has to be the same lender? Let's say if I have two rich uncles, but they're not rich enough to give me the full loan. One gives me 100,000, one gives me 140,000. Could I combine those two, or it has to be one lender?
Let me run the scenario again so you can understand what the question is.
So let's say the example that you were giving of the private money lender, right?
Mm-hmm.
Instead of borrowing all the money from one lender, what if I break the 240,000 between two different lenders?
Yes,
one gives me 100,000. You can do that. Okay.
Yes, as far as the loan is taken at the time of the purchase, then it's split between its first and second. One loan has to be on a second position. Okay. One has to be on the first, one on the second. But as far as it, you can do 3 loans if you want. But all they have to be taken at the time of
the purchase.
Yes, yeah.
Okay, so one would be in first lien holder, second lien holder, third lien holder.
Yes.
Okay, so yeah, I think Warden, to your question, then you could do that. You have the hard money loan and then the origination fee. You could have a private money lender for that, but as long as they're all at the purchase of the property.
Yeah, let's run the scenario that when you don't need your rich uncle, you only have the cash, the property cash, all your cash, the whole 200,000. So if we use the cash to buy it, in order to get it out, we're gonna have a free and clear property, which means there's gonna be no purchase money loan. We're gonna have to wait a year to use the appraisal value and get our cash out. So we have to trick the system, and we have to create 100% purchase money loan using our own cash. So what we do is we create a separate LLC that we use, that we own, that we use as a funding company, as a hard money company. And we call it, funding LLC. We place the cash, purchase the property into the LLC, and then the LLC gives us a private money loan to us personally. So we fund the deal 100%. So our own funding company funds our deal under our personal name. So later, when we go and refinance with the bank refinances the existing loan, pays back the LLC, and since you're the owner of the LLC, you can get the cash back.
That's pretty creative. Would the bank ask if you are related to the LLC, or they don't?
So far, I've never been asked that, but for protection, you can create your LLC in Wyoming or some of these states that have anonymity, and it's hard to find out who owns the LLC. As far as the LLC has something funding capital, something related to hard money, kind of there'll be no questions probably. None of my investors, students, none of them been asked that.
Well, it's a pretty creative way.
This is how it works. So you buy the property, you have 200,000. You have a rehab of 40,000. So the loan you need is going to be for 240,000. The appraisal will come at 300,000. You place 240 cash into the funding LLC, and then you get hard money loan from your funding LLC for 240,000. So personally, on paper, you have zero money. So then you go to the bank once you're done with the rehab and the tenant, and then say, hey, I have a loan from the funding LLC. I'd like to refinance it and put conventional 30-year amortization loan. And they say, fine. They do an appraisal. Appraisal comes in 300,000. They say, okay, max, we can do 80% loan to value. We can give you 240,000. All right. They do the refi, 240,000. They pay the funding LLC, and then after everything's said and done, you withdraw 240,000 out of the funding LLC bank account, and you end up with own a property that it has $60,000 equity, cash flows every month, and you have zero money out of your pocket. So you can take your cash and go and do it next month again. You don't have to wait 1 year. So here's a scenario when you don't have cash. You have cash, but not enough to buy the whole property. You just still have to do a down payment for your hard money guy. So you buy, what you do is you do 80-20 loan. 80% comes from your hard money guy, and the 20% loan, that for 20% for the down payment doesn't come up as a cash from you personally. The 20% comes as a loan from your funding LLC. So you buy the property for 200,000. There's a rehab for 40K. The hard money guy wants a down payment for 40,000. So appraisal is going to be for 300,000. You can borrow only 160K on a first position from the private money, from the hard money guy, but you still have, you need 40K for the down payment and you need 40K for the repairs. So you borrow on a second position loan from your own LLC and you borrow $80,000. So you create 80-20 loan from two different companies. One is the hard money company, one is the company you control. And on paper, you have zero money out of your pocket. So then go after you said and done with repairs and tenant, do rate and term refi, appraisal comes in 300,000. The bank gives you 240K, 80%, because it's a rate in term. There's a two purchase money loans. So you pay off the first position, 160,000. You pay off your own funding LLC, 80,000 goes into the funding LLC bank account, and from that bank account, you withdraw your cash, and next month you do it again. So this is what we call infinite return. And infinite return is achieved when you're generating income when you don't have any of your own money already in the investment. You already got the money out. So for the regular BRRRR to do this, it will take a year. If you do my BRRRR steroid strategy, you can do this every 2 months. Depends how fast you are. It can be done in 30 to 45 days. So regular BRRRR, one property a year. With me, you can do 6 months, 6 properties a year pretty easily.
It's pretty creative.
And Q&As, that's about it, guys. That's the little strategy. It's one part of my buy and hold academy systems, one of the systems that we create. But let's go back and let's see if have some questions I can go over.
Hey, Warden, does that answer your question now to use like a separate LLC? So for any private money that any personal money that you're using?
Yes. So you create your own LLC, and this LLC, you can always reuse it. It's your it's your private hard money company. Okay. You fund the company, and
it's actually pretty creative.
I mean, you can do regular hard money too with the same company, and you can treat it. You can give money to other people too in the meantime if you have a lot of cash. But the main thing is to help yourself and not break the rules.
So what's
go by the rules.
All right. So Janea has a question. The bank usually asks for funding LLC document, doesn't it? Who is signing on behalf of the funding LLC?
No, the bank do not ask for that. The person that asks is the title company. And so then the bank only asks for a payoff, and the title company contacts the lien holders asking for a payoff. And on the final settlement sheet, it says a name and a payoff amount.
And you could always make someone else the representative of the LLC, so your name is not showing up on payoff and stuff.
Let's say Shara has a LLC in like if your brother has a LLC or something that you can borrow from. You know, it's good to be not a person. It's good to be an LLC, so you can. Sounds like an actual business that's lending money. Something with capital, something with funding, something with.
I mean, typically I've seen like investors sometimes use their local attorney as registered agent, and that attorney or someone on your behalf can sign the document. And then let me see a couple of questions on this. So for Melvin has a question. For a creative finance deal, a seller carry note could be paid off at refinance?
Yes.
So let's say, so
anything that's recorded, anything that's recorded as a purchase money lien loan at the property. I've done this with in a wrap, in a seller carryback. It doesn't matter as far as there's a note recorded.
Okay, so it's part of those. So it doesn't have to be actual money coming in. It could be seller holding some,
Yes, I've done this with 100% zero carryback, and it works fine.
Okay, and then I'm guessing when you're doing rate and term finance, you're getting a fixed 30-year, right? Or is it variable? Or that depends on bank?
So I like fixed 30-year loan.
Okay.
In smaller markets, local banks, they will break some of the seasoning rules, but they will probably give the loan as a commercial loan with a five-year arm and adjustable rate on a 25-year amortization. So as a buy and hold investor, or I mean, if I am your coach, I would say you need the lowest possible rate at the longest possible time and locked for that long time. So 30-year with Fannie and Freddie is the best investment loan for us.
Okay. And then Warden has a question. I suppose you would have to promise the private money a return no longer than 1 to 2 months on their money, right? With
yes,
no
of course,
prepayment penalty for the private money also.
Yeah, of course, you have to take care of your lenders. You have to pay interest if it's hard money, if it's uncle or someone. If it's your own money, you don't need to charge yourself. I mean, legally, there's a certain requirement that you need to charge yourself minimum interest rate, but for a month or two, you can go around it. But yes, you have to pay. But here's a trick. For example, if you're buying a property with a tenant already in place, the day of the purchase, let's say you buy the property the first of the month, the rent is due first of the month, and the rent is paid ahead because it's due for the next month. All the interest for any loan is paid in the arrears. So you buy the property today, you get a rent with a tenant in there, and your loan, the first payment from your hard money guy is not due in 30 days. So you use the money from the rent to pay your first mortgage or first hard money loan mortgage payment. That's in the case when you're already buying the property with the tenant.
Okay. And then Brady has a question. Do most credit unions and local banks offer rate and term loans? Would these be considered portfolio loans?
No, this is Fannie and Freddie rules, and everybody plays with the Fannie and Freddie rules. Most of the local banks could have some individual portfolio loans with more flexibility. So you can have some decent rules, but everybody plays with Fannie and Freddie. When they underwrite a loan, they underwrite it so they can, at some point, they're able to sell this loan if they need to. And then 98% of the loans go to Fannie and Freddie. So.
His follow-up question, do Fannie and Freddie require the loan to be in your personal name, no LLC? So when you're doing rate and term refinance,
yeah,
it has to be in your personal.
Any refinancing with Fannie and Freddie, the loan has to be under your personal name. So what you do is, when we purchase this type of properties that we know that they're going to be refinanced within a couple months, we buy them under our personal name immediately. If there's no other way and you're refinancing property under LLC, the day before the refinancing, the title company takes the property out of the LLC under your personal name. You close the refinance, and then the day after the closing, you put the property back into the same LLC.
Or what I've seen, or what I have done, and seen other investors do it from your personal name, you can move it over to a trust, a revocable trust or non-revocable, I forgot which one, but then that doesn't trigger anything with the lender, is kind of what I've seen on my side.
Yeah,
just to put it in the trust. Yeah,
banks have accepted trusts, and I don't know why they haven't accepted LLCs yet, because it's a common practice, and they don't even consider, it's if it's under if you own the LLC, it's practically the same thing.
All right. Janaya has a question, and yeah, I think I also have the same question. I'm sorry, but I'm still not sure if the title company would be okay with me signing the final closing statement as a note holder on my funding LLC on one hand, and as a borrower of my BRRRR LLC on the other hand. Have you done exactly that when it was you personally signing both sides? So you're signing as the borrower, of the term and finance, rate and term finance field. And then you're also signing as the lien holder of the funding LLC.
Yes, you don't sign the final settlement sheet, so no, your signature is not as a lien holder. You don't sign the final settlement sheet. You only sign a payoff request, and the payoff request is between you and the title company, and that's it. Nobody else sees that. You can have, since you're opening a LLC, funding LLC, you create a separate email for that LLC, create a separate bank, you create a separate phone number. You run that LLC as a separate company. And if anybody's asking, yes, I do have hard money business. I lend money. The fact that you're using your own company to lend to you, it's perfectly fine.
So lender is never asking, who is actually the person behind the LLC. The lender is asking the title company for a payoff statement.
Correct.
Interesting. Okay. Jania, did you have any follow-up questions to that? If you want to unmute. All right. Walden has a scenario that he wants to run by you. So purchase price 140,000, rehab 50,000, and ARV is 300,000, right? So total all in 190, ARV is 300, down payment and closing costs for hard money loan of 190 is 11,000, okay? So that's his down payment and closing cost that he has to bring to the table of 11,000. How would you structure this for BRRRR on this property? Owner has to stay in this property until October 31st. Okay, so another couple of months, paying $2,000 a month. She needs the money as soon as possible for her new home being built and other debt due to her DTI, debt to income. Total hard money payment is $2,056 per month. Okay, so $56 more than what the owner is paying. Can I use that seller as a tenant? Also, I want to keep these property as a portfolio. Would you do the rate and term refinance, then cash out, refinance right away? Where are you finding the refinance companies that do 80%? Can you refer some banks?
Does the property need rehab, or it could be rented immediately afterwards?
It does need 50,000. I think 50,000 to get to the ARV of 300,000, but based on the fact that owner is living there, it is functional, it is livable. Hey, Warden, do you want to unmute yourself and if there's any follow-up questions?
Yeah, correct, Sharad. You had it right. So I'm working with a couple of colleagues on this one. They have the scenario where the homeowner, the property is livable, but to get a new tenant in there, probably not going to get the rent, the high rent that it would require probably for a refi and the condition that it's in. So I would say that it does need rehabbing, at least in the bathrooms where there's spongy floors. So I do know that it does need some work in order for it to achieve the true ARV of the 300,000. Correct.
Okay. What about if you do less work? What's going to be the appraisal value?
Probably 250, 260 would be my guess.
So, and you purchased the property for remind me again.
It's the purchase price is 140.
140.
Correct.
Okay. In order to appraise for 250, how much rehab do you need? Half of it, 20K?
Yeah, 25, 30.
25.
Would have to put it into the bathroom, so you're looking at 20 just off of that would be my guess.
So this is what I would recommend. When you go for rental property, you'll be more cost effective. Don't do full rehab. what we're trying to achieve is to have, the best thing is minimum 25% from appraisal value. So let's say if you think that the property is going to appraise for 250 with smaller rehab, 250 minus 25%, that's like hold on, let me see, 250,000 minus
So roughly
25%,
like
187,
190, yeah.
190. So as far you don't pass the 190, the cost for the total project, you'll be fine. So you're buying the property for 140 and up to 190, what's going to be the future 75 LTV from appraisal, you have $50,000. So with these $50,000, you can play with. You can pay closing costs, you can pay rehab, you can pay yourself an assignment fee also. As far as you can borrow,
Yes.
190,000, because you said there's some partners. These partners
Correct.
might want to get some money out of it, so you got to pay them.
Yep. You're exactly right. So that we
So
included.
what I would do, I would buy it for 140. I'll calculate 5K for closing costs. I will probably do $30,000 for rehab. Calculate that, but don't do the rehab until the person is out. And then I'm going to pay your partners 10, 15K for job well done, so they can bring you another deal. And then you're going to be at 190. You borrow 190. I don't know how. Hard money. How do you have cash available?
No, it would be hard money. So
Hard money. So you hard
closing
money
cost-
guy.
yeah, so the closing cost for the 190 is about 11,000 is closing cost to bring to the table.
Why so high? Points. Okay.
Yeah, I think it's points and the origination fee. That's a good question. If I'm looking at it here,
It sounds high to me, but just run it again. Anyway, try to stay within 190 total cost.
Okay.
Not to exceed that. The question is, does your hard money guy wants a down payment, or they will give you the 190?
Yeah, they'll do the 190, no down payments required. Only thing to bring to closing is $10,233.
So that would be your like closing cost and points and stuff, right?
Yeah, it's 100% purchase price and rehab, I guess.
Okay, so that's okay. So, but here's, you bring the 11,000 at closing, but at closing, because you're overfunding yourself with 50,000, you're gonna get 50K in your bank account the next day.
Right.
You get it?
Yes.
So out of the 50K, you're gonna put 30K for rehab.
Yep.
You're gonna have 20K left. You spent 11,000 for closing costs. I urge you to look at it again, because it sounds high on a 140, on 190, and then you have 9,000 to pay your
Assignment fee.
assignment fee or whatever. So play with the numbers.
Okay.
So stay there. So then the next day, actually not the next day. When is the property closing?
We have some time on it, so I think they have it set for end of September, if I'm not mistaken.
Gotcha. Do you think the property is going to appraise as is right now with the tenant, with the person in there for 250?
I think it'll appraise as is right now for maybe 230 to 250. It's going to be close. I think possibly 230 is what I'm seeing from the comp.
What I'm trying to get to is, can you do the refi immediately after you close now? You don't wait to rehab the property.
That's what I'm trying to figure out. Because I know that there's like properties at it in the same condition that have sold for 230 to 250. So I didn't know if that's a scenario where we're allowed to do that.
So let's run the both scenarios so you're prepared for both.
Yep.
So scenario one, you decide to close the property and try to refinance immediately, get out of the 190.
Mm-hmm.
So you have a closing date for the 190 property,
Mm-hmm.
but you don't wait for the closing date to start the new loan. You start in advance. You call your mortgage guy and say, I'm closing on this property. I want to refinance it as quick as possible, because in the first 5 days, it's only paperwork.
Right.
They need an application, statements, all that stuff. So don't waste that time. The moment you close, you call your guy orders the appraisal. The appraisal comes a week later, 10 days later. And then at that point, you see what the appraisal is. If the appraisal comes lower from 250 down to 230,000, if you want to achieve the 75 LTV, you're going to have to come with money on the table
Mm-hmm.
to match that difference that you don't have the 25. But remember, out of closing, you put 30K extra, in your pocket.
Right.
So you can use that $30,000 to offset any differences between the lower appraisal. This could be okay. What I don't like here is you still have a property that needs repairs.
Right.
And the question is, when the owner moves out, can you rent the property in as-is condition or with a minimum patch up 5K type thing repairs? If the answer is no, the property definitely needs work, 30K, in order to be livable in a decent tenant, then I would wait 2 months. Once the person ex-owner moves out, do the rehab for 30K, and then go into the refi. It's going to take you, instead of 2 months, it's going to take you 4 to 5 months.
Right.
But the 2 months with the owner being there and paying you 2K per month, that's going to cover the hard money. And here's the other thing: it's going to give you time to plan. Give you time to plan for the rehab, get bids, multiple bids. You don't have to rush. It can negotiate prices. Second thing is going to help you. Is going to help you with your mortgage guy to collect documents, get you ready, run your credit, see if there's any issues that there might be a reason for you not to qualify. If there is a reason, you have 2 or 3 months to fix that problem. So these are the two scenarios, but you're in a great situation, man. This is a great property, and no matter what you decide to do, you're going to end up with 25,000, 25% equity. That's about 75K. And at the end of the day, you're going to have zero money out of your pocket.
Right.
What's going to be the rent for property like this?
The rents are 18 to 2,000. Rehab, fully rehabbed. So,
man, you'll be cash flowing $200 a month. This is a real infinite return property, and you can do this within. If there was no owner, you can get it done within 2 months and move to the next one.
Right.
The key piece here is that you have a guy that will give you 190. That's going to makes it easy for you.
Mm-hmm.
So.
Right. Okay. Well, I appreciate that information. That was very helpful. Very helpful. I think I have. I think you answered it. Appreciate it, Sharad.
Yeah, of course. So Oggie, I have a question. Let's say if I'm starting out, right? This is super creative, by the way, Oggie, like really, really creative, man. So let's say if I'm starting out, I call my bank to figure out that they will do this. What questions am I asking? Like, am I running them through the scenario? Hey, I have one lender that's going to give me, 100,000. I have another lender that's going to give me, 50,000, take second lien position, and the property will appraise for 200,000. Like, what questions am I asking to make sure that I'm not missing anything? And same thing for my title company. I think those are the two players involved, the lender and the title company. Like, what questions am I asking them?
Don't ask any unordinary questions, because that's bringing red flags. You just act as a business as usual and just call and say, hey, I'd like to apply and for mortgage. I'd like to refinance a property with Fannie and Freddie, regular loan. Can you qualify me? And I'd like to do, I have existing loan. I'd like to do rate and term loan. And Fannie and Freddie guidelines are the same across the country. They're no different. Unless you're trying to use some local bank product that it's different, then you can ask him how it works. I'd like to do rate and term refi. I have an existing loan. I'd like to refinance with another loan. No cash out back to me. And they'll tell you. And then the title company, they're going to ask you, hey, you have a loan on this property? Provide us with a statement or information who's the lender. And all we can do is, here's the lender, LLC, funding LLC. The email is info@fundingllc.com, and this is the Google number you can call. Or if it's a title company that you have relationship, that you work for a long time, you can trust them, then you can bring him and explain how everything works and say, hey, I have ownership in the LLC, and I'll be providing the payoff statement. There should be no problems.
Okay. Yeah. I mean, it just sounds super creative way to not have any money involved. I mean, like you can do some other things with this, I mean, I guess if you wanted to get cash out refinance, you could upfront put a little bit more money from your funding LLC, and then, make that part of the loan when you're doing rate and term refi.
Exactly. So in this case that we talked about, the purchase price is 140, potential appraisal 250. You have a huge gap that you can pay yourself a assignment fee on top of that and still keep the property and still cash flowing. So you don't even bring down payment, you're getting paid to have a rental property.
Yeah. Just from your funding LLC upfront, you're just putting in a little bit more money for a couple of months, and that comes back to you as part of the rate and term refi.
Exactly. And you can calculate the future hard money payments for 2 months. Let's say every month is $2,000, 2 months, $4,000. Or let's say my holding time is going to be 3 months. Total payments to the hard money guy, $6,000. I will calculate this to the loan so I can overfund myself and get the cash that I have to pay for the next 3 months. Yeah. Because when you do this, when you overfund the loan, you bring 190 to the table at the title company. The title company gives 140 to the seller, and the 50 they cut a check to the person on the contract. So that's so whoever is on the contract, that's what the extra money will go to.
Okay.
So
yeah,
the good thing is to have, if you know you're gonna keep the rental property, the property as a rental, then it's good to have your personal name there on the contract, because the extra money will come to you directly. If it's a LLC on the contract, then they cut a check to the LLC, and then you have to take it out of the LLC under your personal name, refi it, and put it back. So it's just extra work. In both scenarios are okay. It just depends. Sometimes, because I have LLCs that are just holding entities and they don't have bank accounts, and when they give me an extra money out of title company on that LLC's name, and I don't have a bank account, makes it extra work for me to open a bank account, cash the check, bring that in sometimes.
Awesome, man. Fantastic. Any other questions, guys, before while we have Oggie for a few more minutes?
Any thoughts about protecting the funds in that funding LLC?
Protecting from who?
I don't know. I'm just thinking, that's a target for, I don't know, maybe a lawsuit or anything. Just how do you think about it?
So the money goes into LLC when you need them. The LLC stays with, you keep $1,000 there. And the day before the funding, you put the money there, then you fund yourself. After the refi, the money goes into the LLC, and then you move them out of the LLC to your safe account that you think it's safe. So you don't hold any money in that LLC unless you have to.
You're just holding it there just for the funding, putting the money in the deal and taking it out of the deal just for that purpose.
Correct.
Yeah.
So that's safe.
Could I get you to reiterate on the lawyer, or you said if we have a local lawyer, what are we directing them to do? I guess to kind of act for us, you know, I guess to separate ourselves for the title company.
So you can run that funding LLC as a separate company, create a separate email, separate phone number, or just give him an email. Don't give him a phone number. And ask him to do, or just explain to the attorney what he's doing. Say, hey, I have an ownership in the funding company that provided the loan. I will be signing as the as a payoff person. Do you think that the attorney is going to have a problem with that?
No, I'm just trying to make sure I understand the framework for it. Yeah, thank you.
Yeah. So legally, you and the LLC is two separate entities. Your person separate from the LLC. LLC, it's a separate on its own.
Interesting. That's super creative, and I appreciate you sharing that.
Yeah, with your I mean, if you have a lot of paid off properties, I don't like that. I told you, but you have a lot, like, because for me, you know, dead money is money sitting in the checking account.
I mean, I have a line of I have a line of credit against those properties that I use for my house flipping business.
Okay, so line of credit is the same as cash. It's perfect. So what you do is pull the line of credit, put it into the funding LLC, fund yourself, refi, and then pay off the line of credit after you all said and done.
Oh man, my mind is already spinning from all the things that you've shared. I need to go back.
This is just one little piece of it. Again. So, but it need to be, you know, there's a lot more to it. The taxes, the legal side, the financing. So, but as you go, you can figure out these things. And if you guys finding this information valuable, consider calling me if you need help. You know, I'll be happy to consult with you. You can call me directly on my cell phone. It's perfectly fine. So.
Yeah, so Oggie has the cell phone number on the screen, guys. And then Oggie, you don't mind if we send it out to our email list, right?
Yes, please. And then, yeah, you can call me and then text me, and I can talk to them over the phone. So.
All right, man. I know we are a few minutes over the 1 hour. So I want to thank you so much for this. I mean, I have to say this has been like one of the most creative things I've seen in real estate investing. I'm actually going to call my lender and find out a little bit more about it, kind of just not tell him, you know, about all the funding LLC stuff.
Yes. So I found that a lot of lenders do not understand this process. So,
but I guess they don't have to, right? I mean, you're just telling them, hey, I have these two, you know, I have loans from these companies, and you paying them off.
Yes and no. I'd rather. I mean, if your lender it thinks it cannot do it, reach out to me. I'll refer you a lender that has been doing this with me for years, and sometimes there's little tricks, you know, things that you have to miss intentionally, not to say, and things like that. So it makes it easy sometimes.
Perfect.
But,
all right. Cool. Awesome, Oggie. Thank you so much. Guys. Hey guys, I also quickly want to mention we're doing our first recently in-person event. I'm dropping the link in the chat. It's going to be October 23rd and 24th in beautiful San Diego. We have some great event planned, awesome speakers lined up. So if you guys are interested, you know, go to the link, and it's bsimply.com/event. You can find out a little bit more about it. If you have any questions, you can send an email to support@bsimply.com. Cool. All right. Thank you everyone for being on the call. This has been like great questions, great info. Thank you, Oggie, for being on the call. I appreciate you.
Let's do it again.
Yeah, absolutely. Yeah. This is like one call. I'm gonna go back and I'm gonna have to listen to this call again to just pick up
Just call me on my cell
information.
phone and
Yeah,
just call me. We'll run that scenario.
Yeah, no, this was like really fantastic. Never would have thought something like this. I'm sure there's some like nuances to it, but yeah, I'm gonna look into this and I'll reach out to you. I think
Yeah,
it
man,
could
burn on steroids.
Yeah, no, this is like absolutely hands down the most creative way to do BRRRR that I've seen. Yeah. Cool. All right. Thank you, Oggie. Thank you so much. Thank you, everyone, for being on the call. I appreciate it. I'll see you guys next week. Thank you.
Thanks.